Hello friends, welcome to Learn Easy. We will discuss forwards in derivatives market. The derivatives market refers to the financial market for derivatives. Derivatives are financial contracts whose values are derived from an underlying asset like commodities, currencies, stocks, bonds, interest rates, etc. They are used for various purposes including hedging against risk, speculation on price movements and facilitating arbitrage opportunities. India has active derivatives market in equity, commodities and currencies. These markets impart liquidity and price discovery to the underlying cash markets. It allows parties to trade specific financial risks such as market risk, credit risks, etc. Types of derivatives are: first, options; second, futures; third, forwards; and fourth, swaps. Our topic is forwards in derivative markets. The forward market is an over-the-counter OTC market where two parties enter into customized contracts to buy or sell an asset at a specified price on a future date. The terms are agreed bilaterally, unlike the standardized contract traded on futures exchanges. The main uses of the forward market in India is to hedge against currency and commodity price risks. Exporters, importers and commodity producers use forward contracts to lock in future prices and mitigate risks. Speculators provide liquidity and absorb risks in forward market. While smaller in size compared to future markets, the forward market provides flexibility as terms are customized as per need. Features of forward. First, forwards are structures whereby two parties confirm in advance for both to buy or sell an asset at a set price, that is the forward price, on some future date. Second, they can be somehow tailored in that they can either be asset-based, quantity-based, price-based or date-based. Third, nonetheless, they are mostly used as a way of fixing the risk of future price movements, but not without a speculative element. Fourth, what distinguishes forward from options is the fact that forward contracts compel the parties to fulfill the transactions at the predetermined price and the set date. If you find the topic interesting and helpful, do subscribe my channel and press the notification bell. Now, examples of forward. An enterprise executes a forward contract to buy the specific amount of crude oil at a specific price that are 60 months from now, being a stretch of time to balance increases in the price factor. Second, a speculative investor can sell a forward contract on an index of stock to the other party and save the selling price at a certain future date from the risk of decline in the market. Third, let us assume that cornflakes are manufactured by firm A, which needs to purchase corn at a price of rupees 10 per quintal from the supplier of corn named B Corns. By making a purchase at rupees 10, firm A making the required margin. However, there is a possibility of heavy rainfall which may destroy the crops planted by B corn and in turn increase the prices of corn in the market, which will affect the profit margin of firm A. However, B corns have made all the possible provisions to save the crops and have this year used better farming equipment for the corn. Therefore, expects higher than the normal growth of the corn without any damage by the rains. Therefore, the two parties came to an agreement for 6 months to fix the price of corn per quintal at rupees 10. Even if the rainfall destroys the crops and the prices increases, farm A would be paying only rupees 10 per quintal, and B corns is also obligated to follow the same terms. However, if the price of the corn falls in the market, in that case, where the rainfall was not as heavy as expected and the demand has risen, farm A would still be paying rupees 10 per quintal, which may be exorbitant during the time. Farm A might have its margins affected too. B corns would be making clear profits from the forward contract. Now, let us conclude. A derivative like forwards is a type of financial contract that can be traded as an investment. To successfully invest or trade or to work in the financial sector, it is necessary to learn and understand the ways derivatives are used. Regardless of our goal as an investor, derivatives like forwards come with potential downsides, including complexity, supply and demand factors, and vulnerability to market sentiment. That's all. Thank you for watching the video.